Welcome back. You're tuned in to Closing Bell and you're watching CNBC TV18. Well, Vaibhav Sanghavi, CEO of Ask Hedge Solution, joins us on the show. Hi, Vaibhav. Good afternoon. Good to see you win. Markets not doing anything, at least for today. But how are you all positioned? I mean, what kind of positioning do you all have? If you'll have a long-short ratio, if you could help us out with that.
Sure, Nigel. I think market, as you rightly mentioned, actually are consolidating between 24,500, 25,000 at this point in time. The way we view it in terms of the market situation as of yet is that, as against earlier kind of time period, especially in the last 3 to 4 months, whatever headwinds we were kind of witnessing or probably a market, had on an overall basis, I think they have to a great extent being mitigated in the sense that the tariff news or the tariff noise, I would say, actually is being fading away in that sense. Lastly, in terms of a geopolitical situation as well, I think that is kind of settled well, in all its context. So what we are seeing from here onwards is a market where the earning expectations were pretty low, and I think the earnings have been pretty okay as per the expectations, along with the worries which are out, from a market standpoint, which brings to the point that on an overall basis, we may see market consolidating to kind of inching up over medium term, from here onwards.
Vaibhav, but do you think we can clock in some decent gains, at least in the second half of the year? We were just chatting with the BofA top team in the morning, and their view is that we're in the last leg of the rally. From here on, their target price for Nifty year end is 25,000. And they're saying that earnings expectation, though there has been a recovery, is still very high, and we could see earnings downgrade. So basically, in a nutshell, it's not that they're seeing too much downside, but the upside appears to be limited. What would your call be, say, for the next 6 months?
So I would say it's 6 to 12 months. In a scenario where we may see dollar depreciating, I think continued inflow to emerging markets will happen. If that happens, along with your domestic flow pretty strong, we may see, or we continue to see, the markets kind of getting supported on the technical side. Whereas in terms of the fundamental side, our strong belief is that because of the measures, both on the monetary side and the fiscal side, which have been taken from the government to kind of, increase the momentum in terms of the GDP growth, while we had always had focus on investment side, I think consumption starts to become a play purely because of the tax benefits and the monetary policy, which have become kind of, accommodative. So decreasing interest rates, higher liquidity, fiscal incentives, all these are likely to help the GDP growth kind of surprise the street on the upside, which is where I do think that, yes, the earning expectations is reasonably okay or probably marginally high as per the street expectations. But my sense is basically, I think we should start some decent recovery on the same in the second half. So markets, I think, are looking up at this point in time. Whether it goes to 25,000 or 25,500, 26,000 is just a number. But whenever we've seen in our experience that the earning momentum starts to kind of improve, then the PE multiples also start to kind of improve.
What would be your top bets from here on? What do you like? What do you dislike? Any new changes that you've made? Any new trends that you've spotted?
Sure. So I think from a sectoral perspective, I think our preference for the next 12 to 24 months would be consumption and consumption-driven sectors, starting with consumer discretionary. Our view is that because of the pretty good focus from both the state governments or central governments and with the RBI in terms of the monetary policies as well, this is a piece which earlier was absent, is now going to kickstart the incremental growth from here onwards. So that's a sector which we like. In addition to that, we are slowly and gradually but surely getting constructive from a medium-term perspective on the IT. We were neutral for quite a long period of time, but now, as the global worries recede, and we see some amount of improvement in terms of your quarterly numbers along with the guidance on a gradual basis, we do think that the valuations are reasonable from an IT space. So that is again a sector which we will look at. Lastly, banks is something we continue to be neutral on. We are waiting for the bank rate cuts to kind of probably happen, and then we will probably take a call, on that sector. And financials is something which we like.
Interesting. From the IT pack itself, what do you like? I recall, I think 12 months or so ago, you all were positive. Then I think you all went into a neutral stance on IT. And now you're again taking a fresh look at it. Will you all go for the mid-cap names that grow at a faster clip, or will you stick to the larger cap names from the tech pack?
See, I think it will be a mix of both in the sense that from an individual company, growth prospects is something where we would probably lay our attention to. Also, all those companies where we've seen a good amount of deterioration because of the lack of visibility in terms of the discretionary spend, our view is that while the free cash flow yields are looking pretty comfortable there, we will try and look for opportunities which give you some amount of downside protection, along with improvement in terms of the future potential deals which may come about. So that is a space which we may look at. And it is, to be honest, I think it can be a little bottom-up driven as well. To go fully bullish on the IT sector, probably it will take a quarter or two to take that view.
I might be wrong, but did you like cement a couple of months back? In one of our conversations, yeah.
Yes, I think we were bullish on cement. I think cement has done well in terms of the sectoral performance. The way the southern prices have kind of held up, I think it's a good sign. Probably it's just at the start of the monsoon, and probably you may see some amount of consolidation in terms of the cement pricing. My guess is basically structurally we may see improvement in the profit matrix because of the overall consolidation in the industry. So cement on declines is something which we continue to like, but not at this point in time.
Any tactical trade on IndusInd Bank?
No, I would probably pass that.
All right. Thank you very much, Vaibhav, for joining in. We'll get into a break. As always, on the other side, we'll get you a check.